Hello again, this is Grant Bledsoe, and today we are talking about interest capitalization on student loans. I've had a couple inquiries recently through the blog and the YouTube channel asking what the deal with student loan interest capitalization is. So I figured it would be helpful to cut a quick video explaining exactly the ins and outs of interest capitalization and why you should probably pay attention to it. So when your student loans under the federal program enter repayment, the default repayment schedule is the 10-year repayment plan. It amortizes over a 10-year period, and you pay a fixed monthly payment. A portion of your payment goes towards interest, and another portion goes towards principal. And the idea is that as you pay down the balance of your loans, a larger and increasing portion of your payment goes towards principal. The issue is that under the income-driven repayment options, so say you pay off your loans under revised pay-as-you-earn, income-based replacement, or income contingent repayment, it's possible that your income is low enough to where your monthly payment that's calculated using one of those repayment plans is actually less than the interest that accrues on your loans each month. Now, if that happens, that accrued interest builds over time, but it's not added to the principal balance of your loans unless it's capitalized. And that can happen for a couple different reasons, which we'll go over later. So here's an example. You've got $50,000 in federal student loans and are paying 5% interest per year. At 5% interest, under the standard 10-year repayment plan, your monthly payment is going to be $530.33. So in month one, we're going to take $50,000, multiply it by 5%, divide by 12. That's the amount of interest that you'd pay in month one, $208.33. You've got a monthly payment of $530.33, and if $208.33 of that is going towards interest, $322 is left over to pay down the principal balance of your loans. And in month two, you run the same calculation using the same monthly payment of $533, but you're calculating interest based on a slightly smaller loan balance because you've already paid off $322 of it. So as you can see, over time, if you keep making your monthly payments of $530.33, an increasing portion of your payment each month as you pay down your loans goes towards principal because you don't have as many, your loans are not as large as they once were and are accruing less interest each month. So let's take a look at an example of accrued interest. Say you've got the same $50,000 in federal student loans, you're paying 5%. Let's also say that you've got an adjusted gross income of $35,000 and you enter revised pay-as-you-earn. Under revised pay-as-you-earn, your monthly payment is going to be 10% of your discretionary income, your minimum monthly payment, that is. That's calculated by taking the difference between your AGI and 150% of the poverty line in your area. So if you're single and live in the lower 48, that's $11,880. 150% of that's $17,820. The difference between your adjusted gross income of $35,000 and 150% of the poverty line is $17,180. Chop that in 12 for monthly income, that's $1,431.67. So 10% of your discretionary income would be $143.17. Remember that our month one interest that accrued was $208.33. So if your monthly payment is only $143.17, that's less than the interest that's accruing in month one. That means that the difference between those two, $65.16, is added to accrued interest. So this is what month two would look like. Take the same $50,000, multiply by 0.05, divide by 12 for an interest accrual of $208.33. Your monthly payment of $133.17 is still less than the interest that's accruing, $208.33, and that means that your total accrued interest would be another month of $65.16, and your total accrued interest would be $130.32. So over time, if you're making your minimum monthly payments, the interest that's accruing is going to be based off that same $50,000 loan balance because you're not paying it off. After 5 months, you're going to have $325.80 in accrued interest. Now let's say that interest is capitalized. Say you forget to recertify your income, or you voluntarily leave revised pay-as-you-earn. And after 5 months, that accrued interest is capitalized and added to your loan balance. Well, your new loan balance is going to be a little bit higher, $50,325.80. In month 6, your interest is going to be based on that higher loan balance. So you can see why you probably want to pay attention to this, because if interest is capitalized, if you're accruing interest because your monthly payments are not enough to cover the interest each month, if that interest is capitalized, you've just added a little bit to your loan balance. And there are certain things that can trigger this capitalization. Under revised pay-as-you-earn, if you leave the program voluntarily or you forget to recertify your income, the interest is going to be capitalized. There's also no limit on the amount that can be capitalized. So that's something to keep in mind as you proceed and as you decide which repayment option to select. Pay as you earn is a little bit different. Remember that we've got a cap on your monthly income payments. So if you enter pay as you earn and you get favorable monthly payments based on your income, but then your income increases beyond the point where your monthly payment is actually higher than it would have been under the 10-year standard repayment plan, you no longer qualify to make payments under pay, and that interest capitalizes. You can stay in pay as you earn, but the interest that's accrued over time capitalizes, and your monthly payment is capped at that amount that you would have paid under the standard 10-year repayment plan. The nice thing about pay as you earn is that there's a limit on the amount that can be capitalized, which is 10% of your original loan balance. So that's a big benefit of pay as you earn. Income-based repayment is very similar to where they have that monthly payment cap of what your payment would have been under the standard 10-year plan. So if your income increases beyond that point, you have a cap on the monthly payment under income-based repayment. The issue, again, is that if that happens, any accrued interest is capitalized and added to the balance of the loans. And under income-based repayment, there's no cap on the amount that can be capitalized and added to your loans as there is in pay-as-you-earn. So that's the quick and dirty overview of interest capitalization for student loans. I hope it was helpful. If you have other questions, please feel free to leave them in the comments or reach out to me directly. Also, be sure to subscribe to Above the Canopy and get free access to the Financial Independence Vault. It's got tons of great resources to help you make good financial decisions and avoid shooting yourselves in the foot. Thanks for watching.